Welcome to another Straight Up Chicago Investor Podcast. I'm 𝗤𝗃𝗀𝗀𝗃, licensed agent with Second City Real Estate. With me, as always, is Mark Ainley, founder and owner of 𝗣cie_𝗰𝘀𝗁. Mark, what do you want the listeners to do to that subscribe button?
Smash that subscribe button and smash that like button and leave us 5-star reviews anywhere you can find. Stitcher, iTunes, Straight Up Chicago Facebook page, everywhere. Please help us spread the quality, the value you're getting from here so other people can see that and then jump on and get the value that we're trying to provide our audience. Man,
you let off with Stitcher. Did not see that one coming. Do we have a Stitcher review? Anyone?
We do. No, we do.
On Stitcher, we want to hear from you.
Yes. No, we do. We get a small percentage, but they're on there as well.
So let's talk about the event. I know this is going to air a couple of weeks after, but this is our first recording since our networking event that we had at Avondale Bowl. Good times.
What a great event. Special shout out to Luke, who allowed us to rent the place out for the night. And what a blast. That environment, that bowling alley, what Luke did to that place and the kind of the what he's created there. It's just, I love having events there. That's the second event I've had there. I was at your first one when you had it. What a great place to even network.
Yeah, awesome. Shout out to everyone who helped with that. I know we're going to leave people out, but 𝗤𝘃𝗲𝗀𝗃 from your team did just a phenomenal job. And then obviously our friends over at Renova for sponsoring as well.
Yeah, what a good time. It was a great, we had Javier was up from Mexico, so that was cool. He's so much of the behind the scenes, but he was actually able to be there. It was awesome. We got our business cards. He was around making friends all around the room. So I've gotten a lot of quality feedback about him. So that was fun. But it was great. I got to meet a lot of people that I haven't met before. I might have emailed them back and forth, but never put the name to the face. So that was pretty exciting. It was a great event. I think we sold out 150 people, and I would guess that 140 of them were there.
Yeah, it was good vibes, good energy, good amount of people. I think any more would have been a little tough.
Yep. So we'll have to figure out. I was trying to think today, when's not too soon to have another event. So we're gonna have to think about that.
There we go. And if you didn't get a t-shirt, you got to reach out to us. Mark spent all the money on those new sexy t-shirts we got.
Yes.
So what do we got for a housing provider tip of the week here?
All right. So I want to point something out, and we're going through this with a couple of tenants right now. Right now, a lot of people are considering selling. They might have owned the property for a while. They got some good equity and they're looking to sell. Maybe they're afraid of what's on the horizon. They want to cash out. And one thing that I'm seeing landlords, housing providers get held up on is if you have a Section 8 tenant, it's hard to get them out to move on the traditional move out date at the end of your notice. Keep in mind the Chicago notices. If you've been somewhere more than 3 years, you have to give 120-day notice. Anything less, you got to give 60-day notice. But for us, we have Section 8 residents that we give them that 60-day notice. And at the end of 60 days, they might mean well, but they couldn't find a place or they couldn't get all of their stuff together to pass the inspection for the new place. And there's these delays. And they don't always get out there day 59 and start looking either. So, and maybe they're underestimating the process. So what my advice here is, if you are looking to get a resident out and it could be Section 8 in Cook County as well too. So HACC or DHA DuPage, we've had this issue as well. So if you are on a timeline, make sure you're working with your resident to help them either A, find somewhere else to live, B, explain to them how long it's been. We had one resident that's been with us 9 years and she just forgot how horrible the process was and how long it takes just to get her paperwork and so forth. So if you are up against the schedule and you're trying to give notice and you have Section 8 residents, just make sure that you are allowing the time or kind of holding your resident's hand to make sure that this goes as smooth as you want it to be.
Good stuff.
All right. Today's guest, I'm excited. He comes to us from Gary Davidson, our friend Gary, who was episode 79. My favorite title episode, I think, was that I Got a Guy. Was that what we called it? Oh, I love it. I Got a Guy. And Gary's guy is today's guest. So our guest today is a founder, CEO, and managing broker of Tenant Advisory Group, LLC. He has been a tenant representative broker for 20 years and started Tenant Advisory Group in July 2008 after gaining experience at several of the major commercial real estate firms in Chicago. He's completed over 1 billion, that's a B, in commercial transactions, and he's been a guest professor at UIC, DePaul, and Columbia College. He has spoken in front of crowds as large as 5,000 people, and he's part of a team developing over 150 million of hotels across the country. He's also invested, and sounds like this is one of, from me talking to him, one of his biggest passions, in and served on the advisory board for over a dozen early stage technology based companies. So anyone with that idea out there, maybe today's guest will be someone you want to talk to. But without further ado, I want to introduce Bill Himmenstein. Bill,
Close enough.
I'm so nervous. It's so funny, listeners. You can always appreciate when I struggle on name because I actually like spell it out based on syllables. Or I sound it out. So, Bill,
well, thank you.
Short. I know you had a very long bio, and I had to cut it down a little to make sure no one didn't lose anybody. But let me know if we left anything out.
No, first of all, thank you so much for having me. I'm very grateful for the opportunity to share some thoughts with you guys. And no, the bio, yeah, I mean, first of all, I need to update the bio. I've actually been in tenant rep brokerage for 22 years. So that's something I need to update there. But no, I love what I do. I enjoy real estate. I enjoy connecting people. But as you touched on earlier, my favorite thing is passive income. And so I'm an avid investor, and I like to try and, get my money working for me as a, gosh, who was the guy in the movie who said money never sleeps? Gordon Gekko. From, what was that movie?
Wall Street.
Wall Street, of course. The original Wall Street, Gordon Gekko says, money never sleeps. And that's how I envision, my real estate investments. I'm asleep, but they're still working and collecting rent. So that's a fun thing for me.
That's awesome. I'll point out one thing. You didn't update how many years you've been in business. And it's funny. I do that all the time. Like, I'm not even sure if it's 17 or 18 or 19, but I remember when we first started, I'd literally round up. I'm like, all right, it's been a year and 1 month. So I've been in business for 2 years. And it's like, oh, we've been in business for 3 years. Like, oh, we're almost 5 years. Like, so I remember like trying to, because you felt insecure about not having the experience or maybe not looking like you know what you're doing, even though you might have known what you're doing. So I remember always rounding up, and now I know how it is. Like, I forget to update websites for years now. So it's kind of funny. But Bill, talk to us. You have some great visions. We're going to talk about a lot of awesome things here today. How'd you get into real estate, or how'd you start this journey?
Yeah, I mean, I would say it was just a really bad mistake that I've tried to make the most out of. There was a lot of different businesses coming to my college campus to interview people, and the predominant focus was on finance and accounting, right? That's what all these big name companies are hiring for, the real smart minds from Washington University in St. Louis. And there was one firm there, a commercial real estate firm based out of Chicago, where I knew I wanted to be. And they started telling me things like, you're going to be working with the CEOs, owners, and C-level executives of these businesses. And you're going to be helping them negotiate one of their second largest expenses, which is their real estate expense. They started talking to me about the value of the commissions that I could earn. And they're starting to tell me, we don't care when you're coming and going as long as you're producing, which I thought was a fair way to be judged. But then they had the hook, and the hook where they got me was, oh yeah, by the way, you're probably going to fail at this. And, that's exactly what they want, is the person, the young, dumb, bullheaded individual that's like, oh no, you can't tell me I'm going to fail. I'm going to prove you wrong. I'm going to show you that I'm not going to fail. That's what they wanted. They wanted the ones where they said, oh, I'm going to fail at this. That's probably not for me. Yeah, good. There's the door. We'll see you later. Don't call us back. But when you said, oh no, I'll show you, they're like, yes, that's what we want. So while all my friends are, at the time, 22 years ago, were signing up for jobs that were going to pay them $70,000, $80,000, I was on a draw. I was going to make negative $24,000. And I remember the phone call with my father. Yeah, Dad, I think the job I'm gonna take is gonna make me negative $24,000 in year one. And sort of like he's been my entire life, incredibly supportive. He said, Bill, if that's what you think is right for you, do it. And he's also the one, by the way, that convinced me it was time to start my own business. I always known I wanted to do that, but I remember it was July of 2008. The world's crumbling around us. I'm playing golf over the 4th with my father, talking about, well, I got some deals in the pipeline. I don't want to leave right now. And he said, Bill, it's never going to be a good time to start your business. That's why you got to do it now. And so it was with that advice that I cut cut the cord and jumped out of the plane, so to speak. Although you shouldn't be cutting the cord if you're jumping out of the plane. I just realized that. But I put my my parachute on and jumped.
I love that. A lot of those perfect decisions, or a lot of those big decisions in life, never have a perfect scenario. You know, you use the one I'll relate to brokerage. Like I hear brokers wanting to leave their broker for 10 years, but they always have a couple deals in the pipeline that they can't justify leaving because they're afraid they're not going to get paid or something like that. So brokers listening, if you want to move, just move, because you're
do it now.
Yeah, it's no point hold up. And then no different than Tom, leaving your day job. And there is a better timing for that, and you have to just not be jump ship. But I think there's never going to be a perfect scenario.
Yeah, absolutely. So I want to talk about this passion for passive income. Before going down that route, talk about having capital on hand and that balance, because we get into this discussion a lot, right? You want to be out there, you want to be generating as much passive income as possible, but you need to have reserves. You need to be ready to pounce. The next big thing might be around the corner. Talk about that balancing act, because a lot of our listeners are probably in their late 20s, early 30s, and they're not sitting on millions of dollars here, right? It's a tough balancing act to follow.
That's a great question, Tom, and you're spot on. I mean, I think the number one key to just savings in general, right, is live below your means. You might have $100,000 in the bank. That does not mean you should go out and look for ways to spend $100,000. I always looked at, if I earn a commission, that's great. I'm really excited about that. I earned money. But I know that if I didn't invest that money, it was just going to get spent on my business or on my family. And so honestly, I started off making smaller investments, fewer and farther between. So I'm not investing $50,000 every month at the beginning. But living below your means will build up your capital reserves, and then making those investments is, at first you might only be getting $150 a month in passive income, and that's not too exciting. That's not life-changing. You just invested, tens of thousands of dollars, and now you're getting $100 a month. That's not that exciting. But you do that 10 times, now you're getting $1,000 a month, and you do that another 10 times, and you're at 2,000. So it's about staying the course, being steady with it. I remember one of the things that sticks out in my mind is many, many years ago, I was with a bunch of my buddies. One of them got a new mattress, and everybody, oh, that's so cool. I want a new mattress. You love yours. I want it too. So everyone starts, while we're there, they're all ordering mattresses, which I don't know how much, whatever a mattress costs. Let's call it $1,000. And I'm thinking to myself, I don't need to keep up with the Joneses. I don't need to keep up. I got a mattress. It works. It's just fine. And what I looked at was, when I spent money, I looked at the future value of that money. The appreciation I might be able to get with an investment, or the passive income I might be able to get with an investment. So that $1,000 to me was worth $20,000 in the future. So I'm like, hell no, I'm not going to buy something I don't need. And that's kind of the mentality, that I took going forward was, look, you don't have to make a ton of investments at big dollars. You just got to be steady with it over time, live below your means. And when you have accrued enough capital, make an investment, buy some real estate. And over time, if you keep doing that, you'll look up one day and you'll say, I've got a nice portfolio that's generating passive income, that's appreciating. And, another thing I'll add by that, living below your means. I mean, I'm going to turn 45 years old tomorrow, and I have lived like I've been broke for that 45 years. Certainly ever since I graduated college, I've lived like I don't have any money, because I'm not out there trying to buy expensive things and toys and whatnot. I'm not knocking that. I mean, some people, that's fine. That gives you a lot of happiness. Fine. To each his own. I'm not judging. I'm just saying that if you're someone that wants to build a portfolio of assets, that's what I always joke with my friends, I'm trying to collect assets. I don't care about cars. I don't care about clothes, as you can tell. I don't care about nice office space, as you can tell. I like to collect assets. And over time, that has served me well. So I can do things that I do care about, like sending my kids to an excellent school, taking a nice vacation with my family, having a nice house, whatever the things that I care about, I've been able to, I guess, procure on behalf of myself and my family because I've lived below my means. I've lived like I've been broke pretty much my whole life.
I think for me, there was a weight off my shoulders. I don't know. I couldn't pinpoint the age, but there's some point in my young adulthood, so young 20s, where I realized I don't give a crap what other people think. I'm not going to go after the expensive car because I'm happy with my cheaper car. I'm going to buy my black t-shirt is the same with a logo or without a logo. My jeans from Kohl's versus Lucky Brand are the same thing. So that there was a freedom for me personally when I stopped caring what other people think. Now, I think there's a level of confidence that comes with that kind of backs you into that. It sounds like you definitely have that, Bill. Is there a way that you'd ever advise people that do care about those more expensive things to look at it other than just kind of the future? I love that.
Sure.
The future value of that money, what it's really worth.
Yeah, no, of course. I mean, it comes down to a budget. So if you're making, let's just say $10,000 a month, all right, and let's just call that after taxes. Just put a budget together. Give yourself some money to spend on things that you want, like nicer clothes, whatever it is, that's fine. I'm not opposed to that. I'm not telling anybody, what to do. But if you do care about building wealth, buying expensive clothes and cars is the exact opposite thing to do if you want to build wealth. Building wealth is about collecting assets, not things, especially things that depreciate substantially in value the second you get them. So make a budget, allocate yourself money to spend on things that you want, and and then of course you've got the things that you have to spend money on, like rent or mortgage, whatever that is, food, your necessities, and then budget money to be saved, set it aside, and just have that be a part of your budget.
Love it.
That would be my advice.
I love it. The whole, if anyone's ever read the book Profit First, you pay yourself your profit before you back into your expenses that way. That's more from the business side, but you went from, all right, we went a little deep there on that one. So that was awesome though. Good information. We never really touched on that. So that's cool. You got into the business, you opened your own business, doing a lot of this brokerage, doing very successfully doing this brokerage. And you went into actually investing and buying multi-unit buildings with a bunch of partnerships. Kind of tell us how you went from your first deal, maybe talk about that or how that looks like. And I'd love to kind of hear how you've kind of built that up.
Yeah, sure. That's a great question. I mean, it's all about networking and seeking out people that are syndicating investments, syndicating deals. Now, I was extremely fortunate where I don't think a lot of people come from a background where my early investments were through my father's network and the people he was investing in real estate his whole life. And he learned that from his parents. And so he taught me at a young age about passive income, about leverage, things like that. And so I was very fortunate. But once I got to Chicago 22 years ago, I started trying to meet people and started to network towards and gravitating towards those people that were putting together real estate investments, and started doing that and just started, investing with them. Then my brother, again, very fortunate. My brother's far smarter than I am. He found a partner and they started putting investment opportunities together. So, on the one hand, I've been fortunate to kind of have it be in my backyard, so to speak, but it's something that we always talked about growing up. We talked about money, investing, saving, passive income, compounding interest, just things like that about wealth building strategies. So I try to do that with my children. My son is 9, and not only does he purchase stocks for himself, he runs all these businesses to make money so he can buy stocks. But he's always asking me, Dad, what stocks pay the best dividend? And I'm like, passive income. Very nice. Let's do it. And so, it's you can instill this in your children at a young age. I don't think there's going to be any children listening to this. So, right, we're listening. There's 20 somethings listening. It's about asking around. It's about, heck, reaching out to me. I'm happy. And you guys, right? We are happy to make those introductions to people that are syndicating deals because they're trying to raise money. And so even if you're only able to invest $10,000, $15,000, $20,000 every 6 months, whatever it is, these people are still going to want your money, right? They're still going to want you to be an investor and to be brought into the mix. So it's just about networking, reaching out to people, asking them about what they're doing. Unfortunately, my first taste of real estate investing was in a sector that, I'm not so bullish on. And I wasn't a long time ago, but that was the opportunity I had. And it was in retail. And those early investments did just fine. They're doing awful today. And the owner of that investment, we were begging him to sell pre-pandemic, and he never did because, that's one thing about these investments is understanding the general partner, what their motivations are, what they're trying to accomplish. And in hindsight, I'm realizing that this guy, he likes the management fee, right? The passive income. He likes the fees he gets for, when you're getting a new loan out. I'm blanking on the word for when you get a refinancing. He loves the fees he gets from refinancing. He basically loves the fees that he gets from owning the property. He doesn't want to sell it because he loses those fees. All right. My interests are not aligned with the owner of these early investments. But later I realized, all right, the sector I think I really like the most, and it holds true to this day, is multifamily residential for a myriad of reasons, which I'm happy to share if we want to dive deeper. But multifamily residential, then I started seeking out those opportunities. I also liked industrial. I also liked medical. I started seeking out those. I realized being an office broker, I understood the economics of ownership of office space much better. I'm like, I don't want that. That's not where I want to own. Now, that doesn't mean that an opportunity is going to present itself that might make sense for you, but you got to evaluate each opportunity as a standalone investment, along with who is the general partner of this investment and what are their motivations? Do they have skin in the game? Are they investing as well? What sort of a benefit are they getting if the deal goes well? Well, what sort of liability do they have if the deal goes poorly? So just some questions like that to think about. But it's really about networking and trying to connect yourself to the people that are putting together those opportunities for people like us, investors.
So, Bill, let's dive into one of those deals, right? If you could, let's take one of the multifamily ones, one of the first ones you did. What area was it in? What attracted you to it? Knowing what you know now, what would you do differently? Just give us a little oral history on one of these deals.
Absolutely. So, I grew up in Kansas City, and so that's where a lot of my family's relationships were. Typically what I look at initially are the returns. What's the pro forma return? And by the way, keep in mind, a pro forma is really, and just depending on who's writing it, but it's mostly
Latin for lie.
What's that?
It's Latin for lie.
Exactly. But basically a pro forma is if everything goes according to plan, this is what we think is going to happen. I like someone that writes a pro forma that says, everything doesn't have to go to plan, and this is what we think is going to happen. If things go better, then this is going to be a better scenario. But I like to see a nice cash on cash return. That's when we're talking about the passive income, and that's kind of the start for me. Is that cash on cash return, also known as a cap rate, right? People look a cap rate is kind of, in my mind, it's easily translatable to that first year cash on cash return. Is that a fair? Would you guys agree with that? I mean, it goes a little deeper, but
I I think it's fair. I argue what my other argument would be: you can use IRR, you can use other statistics, something to showcase what spread you created on the front end. Are you buying a 1.5 million building? And is it really worth 1.8? Right? Like I will sacrifice more of the dividend if I've created that spread. And this comes from the flipping mindset of just what have I created on the front end where I have built-in equity?
Right. Don't they say you make money on the purchase, right? So if you're buying it for a good deal, absolutely. And I agree with you. My mentality is not necessarily a flip mentality. I like that buy and hold. And if it's cash flowing, that's a hard thing to find, is a good cash flowing asset. So if you have it, I like to hold on to it. One thing I don't want to see in a pro forma is appreciation. Don't put future appreciation in your pro forma, because it's a load of hope. You know, that GP is on the drug hopium, and they're taking a lot of hopium and they're hoping that their investment appreciates in value. Now, if you're buying right, as you pointed out, Tom, there's a great chance that you will have appreciation there. But if you can get a solid return with the cash that's left over after debt service, taxes, and expenses on the property. Also, when you're buying down debt, as long as one early mistake I made is we went in an investment that had an interest-only loan, which means we weren't adding any, we weren't getting any additional, again, guys, help me with the word here. When you're buying down debt.
Principal pay down.
Principal pay down.
Exactly. Thank you. Yeah, so just by paying down your principal over time, if you never have any appreciation on the property, you're still getting value back because, on top of those interest payments, you're paying down your debt. You're adding to your principal balance.
I think that's one of the biggest ones that sneaks up on you in a good way. Principal pay down, like especially. So a couple things here I'll just put out there is I think, when you get to year 7 and on, that starts going down faster on the if you have longer term loan. But at the same time, there's little tricks you could do to, if you pay an extra $1,000 a year, like your 30-year loan goes down to 22 years. There's a whole bunch of those calculations on our website, but there's ways to maximize your principal pay down even as well too. And that one is a great one that if you don't watch it, all of a sudden you got another 80, 100 grand worth of equity that you weren't even thinking about.
Yeah, that's such a great point, Mark. And that, to me, that's a more conservative operator. That's a more conservative approach, is really paying attention to that debt service and doing what they can to minimize those future payments. But, back to Tom's point about, if you make your money on the buy. So you want to be buying in areas that you think are growing, especially on the multifamily residential side. If you're in a growing market, that has a great chance of appreciating over time. And so there's another way that you're going to make some money there on the exit or on a refinance, right? If the value of your property's gone up substantially, you're always able to pull out some additional equity that you didn't have when you first bought the property. Let's see. Another interesting, thing that I like to look at is there a value add component? And so a value add component means they being the operators of the investment, are going to try and find ways when they can increase the value of the property. That might be through updating a kitchen, doing some curb appeal work, like the landscaping, redoing the parking lot. There's different things, and I think you guys are probably going to know better than I am, different ways that you can add value to a property. And that, to me, is a really nice opportunity to invest, because then it's like you're going to make your own appreciation, right? You're going to create your own increased value because you've done some things with the property that will allow a higher rent to be collected, like that kitchen and bath upgrade is a great way to do that. So those are some things that I'm looking at. And then it comes down to who's the GP? What sort of past success they've had? Now, here's where you kind of run into something a little tricky. If they've had a lot of success in the past, they're probably not coming to you for money. And they don't want your $20,000 or your $50,000. They're going to people that can write much, much bigger checks. And they're going to be taking a lot more off the top because they've earned that right. You know what I'm saying? They've had successful buys and sells, and they've earned a lot of money for investors. So on the flip side, it's really difficult to really put a lot of value and trust in someone who's doing it for the first time. That's tough, right? There's a lot that can go wrong, as you guys probably know. And so if it's your first time doing it, you're going to be learning all those things that can go wrong. And it's going to be on your investment dollar. So I like to find people that are kind of earlier in their business cycle, fund 2, if they're doing if they're raising funds, you're going to get lower returns than fund 1 or being the first investor in general, assuming that things go well. Because the more success that a GP is going to have or a syndicator is going to have, they are then going to charge more money on the back end for success fees and, a greater percentage of the upside above what they're pro formaing for. But, looking at the operator, understanding their track record, doing some due diligence on them. I think that's important. Do some due diligence on that syndicator. And then just looking at the returns and seeing if those you can be comfortable with.
I think also for me specifically, partners that we've gotten money from, you get them in the first one, and if you make a money, they're the ones who go to the second time, because it's easiest to get money from them. So getting in early is important, because the people that are involved are the ones that are getting asked and voluntarily putting their money in there. And that's a red flag if they're on fund 3 or 4 and they're struggling to get money. So, because that's true. In the first 3 deals, what happened to them? They either didn't make money or something went wrong that you have to be wary of.
Yep. You're talking a lot about due diligence. Talk about rising rates right now, right? Because cap rates are not really being affected too much yet, but we're going to see this, right? Like if rates are at 6 or 7%, all of a sudden your 6 cap isn't doing much for you.
You're spot on, Tom, but even before rates started going up, and I will circle back to that, but there was so much capital since the start of the pandemic to the recent rise in interest rates, so much capital chasing deals, which when you put a higher price tag on a property, that also lowers your cap rate. But when you increase the cost of debt service, that's lowering your NOI, your net operating income, which in turn it's lowering your return. It's lowering your cap rate. So we're seeing a lot of compression on cap rates here. So it's just, you're taking similar risks lately for a lower reward. That's kind of what I see happening right now. But I'm also seeing a lot less opportunities because of it. And so where I've kind of shifted my focus is to something I was never interested in before. And unfortunately, I'm still not interested in it now, but I'm making investments on the development side. So that's where you're going to be able to get more appreciation if you're starting earlier in the process and you're building it yourself. Although that opens up a whole new can of worms of more risks, more moving parts, more things that can go wrong. But I'm seeing, at least on the pro forma, greater opportunity, higher rewards, higher cap rates.
I was afraid you're going to say Bitcoin. I thought, I'm like, oh man, he's going there, is he? No, so
I just don't know much about Bitcoin. I understand the general concept. I've also seen that it's down like 40% this year, and I'm that investor. It's like, oh, it's down 40%. Well, now's a good time to buy. But I don't really know what I'm buying, so I'm not going to tell anyone not to do it because I don't know much about it. But yeah, I mean, obviously, when an asset is depressed, it can be a very good opportunity. And so what I'm seeing a lot, the opportunities that I'm finding, when I say I'm finding, it's someone else finding it and bringing it to me. It's a lot more of knocking on doors. You're not finding great opportunities on the listing sites, whether it's CoStar or MLS or whatever. I mean, right? If it's being advertised, everybody knows about it. So that means everyone's dollars are chasing it. But physically going to the building and saying, hey, is the owner here? Again, I don't do that, but I'm saying if you're looking for yourself for an opportunity, going to that 3 flat, asking them who's the owner. That's where I think you can find decent opportunities. It's very labor intensive, right? It's very time consuming. But I think those off market, direct to the owner type of deals are where you might still be able to find some aggressive opportunities.
Yeah, and in Chicago, we have a huge advantage here too, because for many years they had to put the management side on the property. So it had to say whether, and a lot of these, when you're talking about a 3 unit, it's not professionally managed. It's managed by Tom Shellcross with this phone number. Like it's just right there staring you in the face. And all you need to do is pick up the phone. Like you don't have to do any scrubbing of it. It's right there.
You're spot on. And that is super helpful, 100%. But otherwise, yeah, I mean, you can hire boots on the ground for, college, or high school kids just to go door to door, any building with over 3 units and knock and say, hey, can I get the owner of this building's contact information if they have it, or the management company's contact information? So that's one way to get that information together, or different list services you can pay. But yeah, I mean, with the interest rates rising, it's really simply just compressing the returns that we're seeing. And I think eventually there'll be a small correction, but really with the amount of dollars that are chasing these opportunities, I think it's very important to align yourself with people like you guys that have the infrastructure that can find these opportunities. And hopefully they'll offer you a piece in syndication.
When we talked, I believe you said you have like 30 or 35 limited partner buildings. Where's that going for you? Are those long-term holds? Are there add value you guys will be selling? What's the limited partnership side of your business look like?
Yeah, I mean, so obviously with several dozen of those, they're varied. In general, I'm looking excluding developments, because typically a development is build, sign the tenants, sell it. That's typically the process of a developer. But what I prefer to do is buy an existing property, preferably multifamily. If it's not multifamily, it's more of a commercial building, like an industrial building that they have a long-term lease with a solid credit tenant. It doesn't have to be Amazon in there to do very well. You can have a solid credit tenant. I want the long-term hold. I want those cash flows over time. I like if we're doing a little bit of a value add, because oftentimes after the value add project is complete, after, let's just say 3 or 4 years after your investment, you've bought down some debt, you've done the value add. And so the valuation of the property has gone higher, which means you can refinance and pull out some equity, which means you're going to pay out your investors. Our risk is going to be reduced. Now, we've probably been earning a little bit of monthly cash flow those 3 or 4 years. So we've been reducing our risk because we've been getting some of our initial capital out. Typically on a refi, you guys can refute this, but you might get another 20% of your original investment back, conservatively, maybe 20, 25%. And you've been cash flowing for a little while. So maybe at that point, you got 30, 35% of your money out of that project, yet you still own the same percentage. Now that you're not spending money on the value add component, you potentially, and you're able to get higher rents. So now maybe your distribution goes up. So you were getting, let's call it a 7% annual return. And now maybe you're getting a 10% annual return. So after 4 years, you'd already gotten 30% out. The next year, 40, the next year, 56. So you keep reducing your risk because you keep getting your capital out. But the value of this property has been increasing. You're paying down your debt. So you in theory, you've got a decent amount of accrued equity in there, even though you've gotten out a decent chunk of your equity. So that's the type of stuff that I like to do. And I don't really want to sell. Lately, given the environment we've been in prior to the interest raises, one of the groups that I invest with has sold, let's call it 30 out of the maybe 15, 16, 17 properties that I have with them. And they were just insanely high valuations. So the great part about that is your $1 turns into $3 that you originally invested, let alone the cash flow and the monthly distributions you've been enjoying, potentially the refinance that you enjoyed. Now your $1 is $3. The number one hope is that they find a 1031 exchange, right? So you don't have any tax implications. You can transfer your money into a new investment. And even if your percentage return is less, you might still be earning, in theory, a lot more money than you were earning before on the same amount that you originally invested in. So unfortunately, these were not 1031s because, as I mentioned, the environment is a little different given the interest rate hikes. The returns are lower. There's more capital chasing deals. There's institutional capital chasing deals. They're willing to take much lower returns because they've got hundreds of millions, if not billions of dollars they're trying to park into these investments so they can do what? Earn their fees, right? And generate a decent return for their investors. So it's been more challenging to find new opportunities. I've had to, like I said, take on a little more risk through the development side. And I can share kind of what opportunities and where I think are good if you're looking at the development side of things. But these existing assets, they are getting tougher to find. But I think at the end of the day, if you can be patient, stick with it. I like to invest for the long term. I'm not saying that flipping is not a good strategy. I just don't know as much about it. So that's not a strategy that I pursue because I don't know about it as much. It's about finding what your comfort level is, what your risk tolerance level is, trying to stick with that. One of the reasons why I've gotten into developments and maybe early stage tech investments is because my risk tolerance has grown. I've built this base of, I don't want to use the word wealth, but of assets, right? I've built a base of assets that I think are generating healthy passive income, and I'm more comfortable, right? I don't feel like that broke kid I did when I was in my 20s. I'm still kind of living well below my means because I want to continue to invest and save and leave a legacy for my children. But, it's about kind of finding that risk tolerance and that ideal asset class for you and being consistent and sticking with it.
Yep. So I want to rewind this for a second for our listeners. So whether you're investing as a limited partner or you're buying your own 2-unit, a couple things to pull out there that Bill said. So going back to, let's say you start with a 7% return. You put $50,000 into this thing, whether it's your again, doesn't matter, limited partner 2-unit. But if you're getting a 7% return, that's $3,500 that you're making on your 50. A couple of years go by, you've done a value add, whatever, the markets push you from behind. All of a sudden, you're able to collect, half that money back, right? You have a refi, you have some sort of event where now you get 25 grand back in your pocket. You're still, in theory, making roughly around that same 3,500, but now it's on 25 grand. So now you're making whatever that is, 12, 13, 14%. And you have that 25 grand back in your pocket, minus your gains, to go invest into the next thing. Just on a small scale, and then this whole time, the debt is being paid down. In theory, you're in, real estate tends to go up over time, right? Over the long haul. Doesn't mean it's going to happen in a 3-year period, 5-year period, whatever that is. So that's like the power he's talking about of your 7% becomes 12 pretty quickly, right? And then at some point you have no skin in the game if you want. If you go down that route and you refi and you pull everything out, you now have this asset, the 50K has all been returned back to you, and you go and you rinse and repeat. And everyone's all crazy about, you hear Burr, from Bigger Pockets and doing and accelerating this and doing it all in 9 months or 6 months. And that's great if you can do it, but there's nothing wrong with doing it over a 2-year, 3-year, 4-year, 5-year period, right? Like there's still a ton of value to be had there. And I think that's missed. I think people can't get their money back in 6 months. They get all frustrated and they say, F it, real estate stinks. I can't find any deals.
Well, a lot of the successes that came out of getting your money for 6 months in 6 months is from 10 years ago.
Yeah.
So a lot of what's out there today that you're reading, and maybe someone that stands up in a forum and says, I did this and you could do it too. They bought those properties at 30% less or 40% less and paid 20% less material. So a lot of these strategies, you have to be careful who you're following, might not work in today's market either, like you're saying, and it might take 5 years.
Or they're spending 10, like Blake McCrade is spending 6 figures of marketing every month to find a deal that does this. And if you're going to sit there and just look on Redfin, you're not going to find the same deal. Like that's, you either got to adjust your standards or your criteria, or pony up and really go after some of these more off-market deals that we talked about. But
to what you're saying, Tom, and then what Bill is saying, like you got that, you can do it over a window time. You have, and maybe you're taking some of that out and repaying yourself through the cash flow, which is fine too. But all these tax advantages that you're having, you're hedging against inflation. And then, potentially over time, you'll have that appreciation. So in addition to the principal pay down. So those 5 ways is what's ultimately creating your wealth.
Yeah. So one last question on this subject here, Bill, because a lot of people also come in like, hey, I want to get started. I follow the numbers. This makes sense. I have $5,000 to my name, right? Like, what do you tell to that person who might have the right mindset? They might be saving, but it's going to take them a long time to save. Like at some point you need to generate income or partner or something along those lines. So what would you say to that person who came up to you at a meetup and said, hey, I'd love to get started and, I don't have much capital to my name?
Of course. And I think there's a couple ways to skin this cat here. Number one, you could buy a REIT. Now that you're not necessarily going to get that refi component with a REIT, you are going to get a healthy return. And if there's appreciation on the stock, which is essentially what you're buying, that's a good way to get into real estate with a small amount of money. Number two, crowdfunding. There are real estate investment opportunities in the crowdfunding space. So you can take that $5,000 and you can participate in a syndicated deal that way. I don't have any particular groups to reach out to tell you, but if you Googled real estate crowdfunding, I imagine there's going to be a tremendous amount of opportunities available. And then the third option I would say is you might only have $5,000, but if you've got 9 other friends that each have $5,000, now you got something together. Now you can get a down payment down on something. So there are opportunities. There are ways to do it. I think that the 2 biggest keys, number one, live below your means so you can save money. And number 2, be patient. Unless your strategy is flip, which again, I can't say that good or bad things about that. That's just not my understanding. It's not my business. But for what I'm doing and talking about that value add, talking about the refi down the road and pulling out all, most or all of your capital while still owning the property and then being able to buy another one, it requires patience. So when you make that first investment, you're getting your $3,500 a year, or a couple $100, whatever it is, you're getting a small amount of money every month. Don't get discouraged by that. Get energized, get excited by that, because that's so easily, that small amount of money, the first investment you make, you might double that money the next investment. And then it's just going to keep building on itself. And when you get to be an old man like myself, all of a sudden you look and you go, wait a minute, I don't have to live like I'm broke anymore. I've got the assets. I've got the passive income. It's going to be okay. And so there was years and years and years of just in my mind thinking, I'm broke. I got nothing. I can't go to that restaurant. That's too nice. I can't do that. And now maybe that might be too big of a sacrifice, right? Because folks, everybody has their own approach to finances, but I'm just talking about trying to build wealth, collect assets, and have a nice passive income to where earning to where your day job is less important to earning income because you've got this passive income coming from your investment. So It's about living below your means and being patient.
Good stuff. Mark, you ready to wrap this?
I am ready to wrap.
Let's do this.
All right. So Bill, what's been your superpower? How have you been able to do what you've done in your real estate investment career, which others wish they could do?
That's a good question. I think that, we talked about patience, living below your means. And I was taught these things by my father and my mother. I was very fortunate of learning that early on. And so another benefit that I had to start was a built-in network, but I branched off. I moved to Chicago. I made my own network. And so networking with people, getting to these real estate syndicators, it's just a matter of asking people, hey, do you make investments? I was on the golf course the other day and I'm walking with this guy and I just say, hey, what do you invest in? Just curious, what do you invest in? People think it's taboo to talk about money. You don't have to say how much money you have, but I like asking people, what do you invest in? And sometimes I get some really interesting answers. And I say, you know what? That sounds really interesting. Can you teach me more about that? Or can you introduce me to the person you're investing with? And that's how I find more opportunities. So just ask people, talk to people, network. And then at the end of the day, I think the superpower has been really to be living below my means and staying patient.
It's probably a similar question here, but explicitly, what is the one piece of advice you would tell someone that is yet to buy their first property here in Chicago? Buy
it. Just buy it.
Love it.
You got to get it. Get your money into real estate, not because I'm telling you that it's going to appreciate. It's always going to appreciate. It does not always appreciate. But to Tom's point earlier, if you're buying in the right place, and of course, if you're buying at the right price, you're going to do just fine. And so collect assets. Be a collector of assets.
All right. What do you do for fun?
Oh, boy. I am awful at golf, but I really enjoy it for some reason. I guess I'm a glutton for punishment. I really enjoy spending time with my kids. I got a 9-year-old and a 6-year-old. If there's an open bar, that's an exciting thing for me. I never drink alone. My wife and I never drink by ourselves. So if someone invites me to something and there's an open bar, I'm like, well, yeah, I got to go to that. It's going to be free drinks. Because remember all those years I was living below my means? The whole free aspect, free alcohol to me is very exciting, but that's only if I'm not, actually playing golf, I'll have a drink or a couple drinks, whatever. But with my kids, there's no drinking with the kiddos. But those are the things that I enjoy, hanging out with my kids, playing golf, and a free drink every now and again.
There we go. I don't think anyone could argue with those answers. So, Bill, what's a good book, podcast, or self-development activity that you would recommend to our listeners?
Oh, man, there's a lot of good stuff out there. There's this one book I really, really like called The Secret of Shelter Island. And essentially, The Secret of Shelter Island, it's about attitude. And it's about being positive. And it's about, continuing to move forward, seeing the good in others, seeing the good in yourself, and just keeping that positive attitude, because not every investment I've made has worked out. Not every decision I've made has worked out. And not everything about me is great. And I think if you can keep that positive mindset, that attitude of abundance, a growth mindset, then you'll be able to take the lumps and get to the good stuff a little bit easier. So that The Secret of Shelter Island for me was kind of a game changer. It just really focused on your own attitude. And so whether you're wealthy or not, but I think that's a great read.
Awesome. Mark, I haven't done that one. Have you?
I have not. I wrote it down though, for sure.
Nice.
All right. Besides yourself, name one person in your local network that you would highly recommend to other investors as a quality resource.
Other investors, who would I network with? Who might be, aside from you two guys, I'm imagining you guys have a lot of great opportunities. I would go to an easy person to get in front of is a commercial banker. And commercial bankers know who's buying stuff, which of their clients are buying properties, and ask them, who's buying stuff? Can you introduce me to them? And even if you're just picking their brain or asking what they're doing, but if you can get to the people that are buying properties, even if you're not able to invest with them, they will share what they're doing. You can pick their brains and it will be valuable. And I think it starts with commercial bankers, which are easy to get to. They're always either golfing or at the bar. So.
We've come full circle.
Right.
Bill, thank you so much. You provide a ton of value to our listeners. How can they learn more about you? Is there any way they can provide value to you?
Yeah, well, that's a nice question. I mean, my business is Tenant Advisory Group. It's tagcommercialbroker.com. We're very responsive. We typically, our core business is helping other business with their real estate needs. So whether they lease, purchase, or are selling properties, commercial properties, that's who we work with. But we're always happy to have conversations with people. I'm happy to make introductions to other syndicators, other people that are putting together investment opportunities. And, that's a big thing I really care about is just supporting the Chicago community. I'm a firm believer in a rising tide lifts all boats. And, if people reach out to me because they heard this podcast, then, I'm going to do what I can to steer them in the right direction.
Awesome. That's wonderful.
Love it. All right. So we end with the Chicago fact. There'll be multiple choice here. I'll give Mark a shot and I'll give you a shot as well. So Mark, I don't know if you read headlines, but my wife. Hold on.
This one.
Sorry. Yeah. Who's our guy?
Pull the name Gene. I'm going to pronounce it wrong, but 𝗬𝘃𝗲𝗀𝗃 out of Oak Park. So Gene, if I get this question right, you get a $50 gift card sponsored by Renovo.
Beautiful. All right. So no pressure. So I think there's a huge lifeguard shortage. We only have like 10% of the spots filled or something along those lines. But according to Chicago Stats and Fact page, roughly how many public swimming pools exist within the city of Chicago? And your options are 40, 80, 160, 320.
Man, I feel like I read an article on this recently with lifeguards shortage. I'd probably say 80. I'll say. All
right, Bill, you want to throw a number out there?
I'm going to go C. Was that 160?
Yeah, 160.
I'll go C.
Hey, Gene gets his gift card, Mark. You nailed this one, 80.
Well, I figured 77 communities and they threw 3 more pools in somewhere else. That was where I went with that. All right. Awesome show, Bill. Awesome show, Tom. Thank you guys both. Listeners, check out. We have a whole bunch of pictures on our website from our summer party networking event we had last week. So check those out. Definitely also go on there and you could get your tickets for the MBOA summer soiree. Get those tickets. You get right from our website. It'll link you to the proper registration form. That's coming up in August 10th or 11th. I forgot what it was.
11th.
11th. All right. August 11th. So get those tickets. Make sure you're there. And then Bill, thank you again. Tom, thank you as always. Listeners, we'll see you next week.
Thanks all.